Hello there and welcome to our talking point session today. Now, for those of you who are new to the channel or our videos, each week we spend a little bit of time with an expert in their field and we talk a little bit more about important topics for investors and business people alike. And today we're talking about a topic that is so important for anyone who's planning on starting a business or even a side hustle. Now, one of those positive outcomes of the pandemic is that there's been a surge of people starting new and innovative businesses. But without the correct structures in the beginning, the businesses are not in a position to thrive. So to help us understand the difference between the structures and their benefits, please welcome our resident tax expert, Cassie Henning. Cassie, thanks so much for taking the time to join us again today.
Thanks, Damien. Thanks for having me.
Brilliant. Now, the first question, Cassie, is I think a lot of people have heard a lot of the terms like, the closed corp and the PTY. Can you give us a little bit of an indication of what the different kinds of business structures are in South Africa?
I mean, okay, so there was originally, they called it the closed corporation. So, and a PTY, and you got your personal capacity as well. So with closed corporations, there's no more issuing of closed corporations. So people that have closed corporations can carry on with that, but they don't register new ones. And then obviously you get your PTY, your normal PTYs that people normally trade in, and that's got a share value to that PTY, or shareholding, if you want to call it like that. And then obviously you can trade out of your personal name as a sole proprietor.
Now, Cassie, we spoke a little bit about these, but obviously there are benefits, pros and cons to each of them. So what are the tax benefits of a sole proprietorship and a PTY and any other structure?
Okay, so basically, if we start with a sole prop trading out of your own capacity, that means basically you trade out of your name, and that's in your personal capacity or personal income tax, if we want to call it like that. So you work on a gliding scale and you get taxed on that gliding scale as if you would receive a salary or whatever. So the thing is, you trade out of your personal capacity, income and expenses are deductible, or you can play it off against each other. And at the end of the day, on that certain amount in that certain bracket, you're going to pay your tax. Where in a CC, you can qualify for much lower tax if you adhere to certain things in a CC, so then you can pay much lower tax than as in a company. So a company was at 28%. The government luckily decided to make it 27%. So that's a flat rate. So in a CC, it's a flat rate. In a PTY, it's a flat rate versus sole prop that can vary from time to time.
Now, Cassie, a sole proprietorship is obviously one of the easiest ways to start a business because it's in your personal name. But what are the restrictions that obviously might deter someone from going this route?
Well, in a sole prop, I always say, yeah, there's easy trade out of your name and whatever. But when you get to that tax bracket where your tax is more than that 27% of a company, I would switch then rather to a company. So what people do in sole props, they can register for VAT in their names and all of that, but then I won't do that. I would rather stick to a company because your tax rate is going to be better. And when you have suppliers and people that you need to pay, and you're in the sole prop and you change to a PTY after the 28% bracket tax or 27%, then you need to let your suppliers know and all of that. But yes, you can start a business in your personal capacity. But if it reached a fair value, that business, I would rather then say, listen, let's move it over to a PTY.
Now, obviously, every business has their own assets. And what is the best way to hold those assets? Is it in your personal name? Do you put the assets in the name of the company? Or what is the best way around that?
Well, Damien, the ideal business structure would be if you have a PTY, the shareholding of that PTY shouldn't be in your personal capacity. It should be rather in a trust. We call it a share trust. So the share trust owns basically the PTY. And then if you have equipment in that company, in your PTY, you're manufacturing, or you're a builder and you've got all your tools, I would rather put those tools, take it out of the PTY and rather put it into a company asset trust. So whenever something goes wrong in your PTY scenario, you don't lose your tools. So you can go around the corner, as Mr. Kutsi always say, you can go around the corner and open up a new shop. That's for safekeeping and risk management as well. So where you got a fair amount of fair value tools, a fair amount of tools in the sense that it's let's call it expensive to be replaced, or you're manufacturing and you don't want to lose your machines. So then yes, I would suggest the company asset trust. So basically you're going to have three entities within one entity, if you can call it like that. So your business will have a share trust, company asset trust, and your PTY that you'll do your normal trading out of.
Now, Cassie, we got a couple of questions from our readers who read our weekly articles. And one of them says, where does a closed corporation fit in when there are two partners involved?
Okay, so a closed corporation's got members. So obviously there's two partners involved. So both of those partners or members have, say, for instance, 50-50 membership into that CC. Now, with a CC, it's sometimes very tricky to bring a CC into a trust. We always suggest that you rather convert it to a PTY and put the shareholding in a trust. There's very much technical issues when it comes to putting a CC in a trust because of the beneficiaries, and if you're not careful, your CC can bomb out, because then you can have more than 10 members on your CC, and that's not allowed. The CC has only 10 members. So yes, my suggestion is rather convert it to a PTY and put 50% shares, 50% shares in each of those persons' share trust, for instance.
Now, Cassie, if you form a PTY Limited, you're obviously liable for expenses and possibly finance for operations. Now, the main member's credit score is then used as a measure from the financial institutes. So how can you circumvent this, or can you even circumvent this?
Remember, every company, if it's a new company, the director will always, or the director of the company will need to sign surety or prove affordability if they want to buy something. At the later stage, and the company is operational, they will look at the financial statements of the company. So say, let's call it after 2 years, the company has 2 sets of financial statements, and then basically the banks will look at the company and obviously the directors, because the banks would or will work with a natural person. They want to work with a natural person. So there will always be a natural person signing something on behalf of a company or a trust or CC. Yes.
Kathy, the last question we got for today is a question from one of our listeners as well. They own a new property through the bank and they rent it out, and the rental is the same as the monthly bond payments. So that sort of evens out. So where must this be kept? Is it advisable to keep it in the name of the person, in a trust, or in a company that is related to a trust?
I always say, if you deal in South African property, you do a South African trust, let's call it a property trust. I would suggest that that person try to move his property into a trust, first of all, for estate planning reasons. And then obviously you want to build up an investment portfolio or property portfolio in a trust. So yes, that person already got a property in his name, so he can buy a property. And with the whole wealth mastery system where you can refinance, I would then rather say, listen, keep that property in a trust. The main thing is, at one stage, you are going to turn positive in your personal capacity, where it comes to that rent that's more than the bond and more than it expenses. So yes, some people believe it's better to have it in their personal name at the beginning because they get money back from themselves. But at one stage, it is going to change and you're going to start paying tax on it. And say, for instance, you want to buy another property, yes, but now you're building up your estate now. So that's why we say rather move it to the trust, where we can say, listen, okay, rather refinance, buy another property, but you're not building up or increasing your estate. You're rather doing it in a trust where we can manage the tax accordingly.
Fantastic. Cassie, thank you so much for this valuable insight. I always say that education is the most important part of studying a new venture. So I think you've enlightened many, many people here today. So if you're watching, please leave your thoughts and comments below and just follow us on our social channels. All the links will be placed in the description below. And if you'd like to see a specific topic covered in our weekly talking points, please send an email to the email address in the description below, and we will try and get to as many of those as possible. If you liked our content, please also consider liking and sharing with future entrepreneurs and friends, and let's work together to build our economy. Cassie, thank you so much again, and we'll see you again very soon.